Welcome back, everyone. Michael here with Offshore Citizen. We're going to do a little niche discussion today, a little bit in response to a question from a client that I was dealing with earlier and maybe applicable to a bunch of the rest of you. And this is to do with tax deferral, real estate investing, and in particular, international real estate investing for Americans. So we're going to discuss the subject of 1031 exchanges. I'll talk about what that is in general for those of you who aren't familiar. And in particular, 1031 exchanges for foreign real estate investments. So let's dive in. Before we do, if you haven't already, please smash the subscribe button, hit the all notifications, make sure you don't miss out on any of our videos. If you'd like help with international tax optimization, forming companies, opening bank accounts, setting up international offshore companies and bank accounts, getting residencies, citizenships, including unofficial citizenships, etc., please reach out to me. You can book a call, calendly.com/Michael-Rosmer, link in the description below, or send a message through our websites, offshorecitizen.net or offshorecapitalist.com. Okay, so first of all, before we even talk about what is a 1031 exchange, let's talk about the concept of deferral. I mentioned this before. Deferral is a highly underrated tax optimization strategy. So, often when I'm talking to people, we're talking about tax optimization, and very often people are looking at the tax rate. And I would say that it's kind of a simple way of looking at it. It's certainly nice to be able to go to someplace like Dubai and pay zero tax, and that's that, right? But in some cases, maybe that's not available to you. And there's a lot of ways to optimize in general, which is why sometimes they'll say that the effective tax rate is much lower than the actual tax rate in a bunch of these places, okay? So just quickly, the value of deferral is if I don't have to pay tax today, okay, then I have a larger amount of money to reinvest, which means that larger amount is compounding, and over time that amount can add up to a lot. The thing that I give an example of very often is what I call the Tony Robbins math, which is if you take $1, you double it 20 times, so let's say 20 years, whatever, it becomes a little over $1 million. Of course, nobody's starting with $1, but that's a whole other conversation. And if you have to pay tax along the way, how much does that hurt you? So say it's 33%, so 1 becomes 2, but then you pay 33%, you get 1.67, etc. At the end of 20 periods, for the one example, you're at $1 million, how much are you at in the taxed along the way option? Some people might say, 33%, that would put you at about $670,000. The truth is $28,000, so it costs you over $1 million in growth, so it's a really, really big difference. And so there's a lot of value in deferral, right? In addition, there can be some other benefits in that maybe in the future you can move to a place where you can get out with zero tax, you can restructure somehow, et cetera, et cetera. So anyway, bottom line is deferral is really valuable. Now, in the US, real estate in general tends to be fairly tax deferred unless you're in a place like Spain that has a wealth tax on expensive properties. So, in that case, obviously you're paying, your value is being eroded every year. But in most places, you buy a property, you hold it for whatever period of time, and as it grows, the growth compounds without any tax along the way, which is great. But what if you want to sell a property and move to another property? Or you want to say the market goes crazy, you want to sell out and roll into a future one. This is where a 1031 exchange comes in. So this is what's called a like-kind exchange. There's actually multiple types of like-kind exchanges, but for our purposes, we're talking about real estate. You can do it with art, you can do it with a bunch of things. And so in the US, there are provisions where you can, when you sell a property, you can escrow the money, and then you can go and buy another property within a particular period of time and not have to pay tax on the swap from one to another. Okay, so it's pretty useful. It's really common amongst real estate investors there. Unfortunately, it's not available in places like, say, Canada, etc. The question is, as an American, could you qualify for this on foreign property? And the answer is yes and no. So what does this mean? Well, a US property is not considered like kind with a foreign property. In other words, you can't sell a US property and roll the money into a foreign property and benefit from the 1031 exchange. On the flip side, you can't sell a foreign property and roll it into a US property. However, you can sell a foreign property and roll it into another foreign property. Now, this of course does nothing with respect to the foreign tax, which may be irrelevant, but you can at least do this. So in places like, let's just use an example. I was talking to a client yesterday who's working on the citizenship in Turkey. just bought some property there. And so in that case, say after 5 years, he decides to sell the property. After 5 years in Turkey, you don't pay capital gains. So then he wants to go and buy a new place in Turkey. Well, he would have the ability, if he was an American, to roll that property over into the next property, not pay US tax along the way, and continue that growth. So anyway, that's the basic concept. The answer, as I mentioned, is foreign to foreign does qualify. Domestic to domestic does qualify. Foreign to domestic, domestic to foreign doesn't qualify. But at least it can be a useful strategy in some cases. So I hope that helps. If you have any questions, put them in the comments below. Follow me on Twitter at Michael Rusmer, and I'm going to look forward to seeing you guys on the next video.